Welcome back, investors, to Ticker Time News. I'm Adam, and Upstart has fallen aggressively after the company released its Q1 earnings report. The Q1 results exceeded expectations, but Upstart's downside revenue guidance for Q2 and fiscal year 22 is totally spooking investors. So let's understand the why of Upstart, as in, why did the stock lose over half its value in just a day? To start, Upstart provides an AI-based lending platform for banks. It aims to consider factors beyond just your FICO score and help those with bad or not so good credit get approved for loans. Now, it's widely known that Upstart's financials and stock performance have been on a roller coaster ride ever since its IPO in December of 2020. And this quarter's massive earnings reaction is just the latest extension of that wild ride. Now, there's a few reasons for why Upstart provided weak guidance, and the biggest issue seems to be rising interest rates. Upstart noted that because the Fed is planning to aggressively raise rates this year to combat inflation, that these higher rates will lead to less demand for loans. Upstart also noted that lending is a cyclical industry, and it expects volume and pricing on its platform to vary. Okay, all that makes sense. Then, Upstart said that fears about the economy, Russia's invasion of Ukraine, inflation, and COVID lockdowns in China are among other pressures impacting its outlook. As a result of increased risk in the economy, banks are demanding higher returns on loans. The average loan pricing on Upstart's platform has increased more than 300 basis points since last October. You only need to look at mortgage rates to see this too. Just this year alone, mortgage rates have increased the monthly payment on a $400,000 loan by $700 a month. That's a lot, and the Fed's just getting started with raising rates too. Now, on a more positive note, Upstart is making progress on its auto loan offering. Upstart mainly focuses on personal loans, but it has been expanding into the potentially lucrative $1 trillion auto loan market. Upstart has conceded that scaling the auto business is no simple task, as distribution channels and auto refinance channels are not nearly as well established as they are in personal lending. Making progress, though, Upstart added a huge number of lenders and car dealerships during Q1. It now has more than 500 dealerships on Upstart, as well as 57 banks, versus just 10 in late 2020. In Q1, Upstart transacted more than 11,000 auto refinance loans, almost twice as many as it did in all of 2021. The company is already starting to publicly test its next product category, small dollar loans, offering a few $100s to help people with immediate cash needs to repay in just a few months. It's almost like a buy now, pay later idea that is used by its peer, Affirm. Interesting. Now, like I've said before, Upstart's mission is intriguing. It helps banks by expanding the loan decision beyond the FICO score, a metric that Upstart views as outdated, as it came out way before cloud computing and modern data science could contribute to borrower profiles. Upstart is particularly helpful to small and medium-sized banks, which have outdated technology. The problem is that, unlike most cloud computing stocks, which charge subscriptions and have a predictable recurring revenue stream, Upstart gets paid by each loan made, so its fortunes will rise and fall with lending volumes. Thus, rising rates will hurt sales for the balance of 2022 and possibly beyond. From an investment perspective, I would stay on the sidelines for now. What do you think about Upstart? Let me know in the comments below, as your comments help us all to better understand. Help us out by smashing that like button, sharing this video wherever you can, and join us in beating this crazy market by clicking the first link in the description. I'll see you there soon. And if it's your first time watching, click subscribe. For Ticker Time News, I'm Adam. Thank you so very much for watching, and I'll see you in the next video.